Now, it was the response to all of this interest rate volatility that led to the destruction of the pension system. And I'm going to explain to you how that happened now. And really what happened is that it drove something, an innovation, they said, called the assumed rate of return. And they also started to smooth something called the discount rate. Now, the pension funds in America, the pension fund, I'm talking pretty much today about public pension funds. There are very few defined benefit funds left in corporate America. They're all defined contribution funds where the companies make a contribution, and what's ever left at the end of the day, good luck and goodbye. In the case of defined benefit plans, workers today, virtually all municipal and state workers who have defined benefit plans get a percentage of their salary, and they're not at risk to volatility in the market. But in 1971, when all of this volatility and interest rates got started, generally accepted accounting principles required that the pension plans, even though the companies did not have access to the money in the plans, were part of the company's balance sheet. And when you had volatility in interest rates, you had volatility in what they call the discount rate, which measures the amount of liabilities in the future. And so that started to go up and down. Stay with me for a second, please. And you also started to have volatility in the return on assets. In the beginning, by the way, in the 1950s, virtually all pension money was invested in fixed income securities, government securities. They knew from the experience of the Great Depression that investing in equities was too risky. But once you start to have all this volatility in interest rates, for accounting purposes, the changes in pension plan assets flowed through to the income statement of the companies, and so you started to have volatility in reported earnings from companies. And what happens in our world is that publicly traded companies get penalized if they have volatility in earnings. And so what company management did was they went to the accountants and they said, look, these liabilities, these payments that we're going to make to retirees, that's not going to be for many years. Why don't we smooth out this volatility, some kind of formula, and extrapolate the returns on assets, on the equity side, so we don't have this volatility in the income statement, and the accountants went along with that. Now, be mindful that the accountants are paid by management. Let's go to that next one. So it was a response to the interest rate volatility that led to the destruction of the pension system. And now you have the assumed rate of return on pension plan assets, and you have smoothing on the discount rate for pension liabilities. Okay. So the question now comes up, well, how high should this assumed rate of return on pension plan assets be? And who makes that decision? Well, that decision is made by the actuaries and the accountants. And who pays the actuaries and the accountants? Well, it's company management. And as far as company management is concerned, they are much better off if the assumed rate of return is higher, because then they get to make less contributions to the pension plan, and they're much better off if the discount rate, which in most cases is pretty much out of their hands. In privately held pension plans, they use the U.S. government bond rate. In municipal pension plans, state municipal plans, they use the same rate as the assumed rate of return, which means they discount the liabilities. What happens is they overstated the return on assets and they understated the liabilities. So in effect, by the end of the 1980s, major companies like IBM didn't have to make any more contributions to their plan, whereas at the beginning of the 1980s, they were contributing something like $1 billion a year. So in other words, $1 billion a year, which used to be an expense, now fell to the bottom line, made IBM look like a much more profitable company. The stock went higher. The options that management got were greater. However, what happened was, as time went on, the pension plans became more and more underfunded. At the same time, the money being created out of nothing, a lot of that money started to leak into the capital markets, and it started to drive equity prices much higher. And this chart shows the rise in the S&P 500. This is the 500 most valuable companies, the market capitalization, the value of the 500 most valuable companies traded. And as you can see, after the last tie to gold was broken, the S&P 500 just took off. Well, let me tell you, it wasn't just the S&P 500 that took off. which gave people, by the way, especially middle-class people who had money in IRAs or Keogh plans, gave them the feeling that they were participating in all of this money creation somehow. But it also resulted in salaries going up, although for working people, ordinary working people, the amount of salary increases always lagged the consumer price index, always lagged inflation. And so from the 1970s to present, real wages for ordinary working people went down. So even though the financial guys and people who had money in the stock market, they were doing famously, ordinary working people, they were suffering. And of course, real estate started to go up, and everybody figures, well, I'm getting rich because my house is worth more. But really, folks, what's happening is you're living in the same house. The only thing that's really changing is that your real estate taxes are going up. And if you sell your house and you don't buy another house right away, you have to pay a capital gains tax on the gain. So there was an exclusion there, but the bottom line is no ordinary people did not profit from this. The people who profited, I don't have time to go into it in detail this evening, were pretty much the financial sector. But another group that profited from this, and those were the politicians. Because as everything, all the nominal valuations went up, tax receipts went up. You can see after the last tie to gold was broken, tax receipts took off. Of course, come 2002 and 2008, these tax receipts started to go down. But the result of all of these tax receipts going up, now you had politicians making promises to working people that they should not have made and cannot be kept, because what was happening, just like everybody else, the politicians are extrapolating the tax receipts into the stratosphere. And also, the politicians have a conflict of interest. Now, stay with me, please. The politicians have a conflict of interest with people because the politicians have a short time horizon, and their horizon is pretty much to the next election. Ordinary people, they're looking for when they retire. And so whereas the politicians to stay in office this term and next time can make all kinds of promises, by the time these promises come due, they're gone. Nelson Rockefeller is gone. George Pataki is gone. Mario Cuomo is gone. But all the stuff that they put in place, now the bill is coming due, and you know what, folks? This can't be met. One of the ways government has been financing itself all along is borrowing. Now let's have that slide. And so this slide shows, one slide back, please. One slide back, please. There we go. No, actually, you're 2 slides ahead. 2 slides back. One more back. Right. So this slide shows government debt. And as you can see, U.S. government debt exploded after the last tie to gold was broken. Today, the nominal value is something like 13 trillion. It just hit maybe 14 trillion. But this does not count the 6 trillion additional from the government-sponsored entities that the government just took over, Fannie Mae and Freddie Mac. And if you start adding in the deficits going forward, you're talking about, in the next few years, the debt's going to reach something like $20–25 trillion. They can neither service nor repay that debt, and they don't have the intent of repaying or servicing that debt. And in effect, that makes that a fraudulent transaction. And now go to the next slide. And it's the same thing with state and local debt. And so today, state and local debt is something like $2.8 trillion. There is neither the intention nor the ability to ever repay that debt. That debt is fraudulent debt. And to the extent that that debt is in pension plans, that portion of it absolutely is going to be defaulted by currency debasement. And you'll see more about that in a minute. And while the government is going into debt, the banks are creating money hand over fist. And if you look at the total debt in the United States, according to the Federal Reserve Flow of Funds report, it's something north of $50 trillion. And so what's the collateral for all this debt? Well, mostly it's real estate, and the real estate's melting away. You're going to have defaults in something on the order of 10, maybe $20 trillion. And to the extent that any of that's in pension plan assets are going to go down into the sewer. And it ought to become apparent to you right now, if it wasn't apparent before, that these pensions cannot be paid. I mean, people are not going to get their pensions. Well, another problem, which I've spoken about a lot, is that these pension plan assets are almost entirely denominated in what's called dollars. Well, you know, come 1971, when President Nixon temporarily, he said, defaulted on the last promise to redeem dollars to foreign central banks and foreign governments at the rate of $35 an ounce, these dollars, which weren't dollars for a long, long time, not since the Civil War pretty much, actually since 1933, these dollars, these bills that you have, they were promises to pay either gold or silver on demand. And so what happened was all of these promises to pay were defaulted. And what's happened now is that the dollars that are in people's pension plan, these are all denominated in broken promises to pay, defaulted promissory notes. And so the question that I ask is, why should a defaulted promissory note maintain any value? And the answer is there's no reason whatsoever. And the evidence is that they're depreciating in value. And at some point, maybe while you're watching this show, they're going to depreciate down to zero. So you now come to what's the best way to protect yourself? And the most efficient way to protect yourself, not the only way to protect yourself, is with gold. However, and take a look, let's have that next slide, please. If you look at the gold appreciation in US dollars for the last 10 years, it's up double digits in almost every year. Average appreciation 18% over that period. Go to the next slide, please. And as you can see, every year gold is higher than the prior year. But one of the things, if you go to your stockbroker or the people who do the allocations for pensions, they say, we don't want any gold, it's risky, it's volatile. What are these people talking about? I mean, this is the best investment return of any asset class, and as you'll see in just a moment, pension plans in America have virtually none of it. And the reason is Wall Street, which is in control of all this stuff, is a fee business. Wall Street is in it for the fees. And when people buy gold, when pension plans buy gold, the fee stream stops. And so what happens is they put pension plans, and say if you're in a building in New York, say a co-op or a condo, and there's a reserve fund, all that money is invested not in gold, it's invested in the irredeemable paper tickets, again, for the benefit of Wall Street. And if you look at the history of the price of gold, going back, say, to 1900, you see it was fixed by price for a long time, up until 1970. It was a little blip there. It went from $35 an ounce to $42 an ounce. And then it peaked around 1980, 1981, when people at that time were worried about the monetary system. And then you see it started to decrease in dollars. But while it decreased in dollars, it increased in a lot of other currencies. And so really, folks, gold is a worldwide market. And so a lot of times when other currencies were collapsing, people not knowing about gold, not understanding about paper ticket money, would buy dollars. So people in South America and Mexico and Brazil, places like that, when their money was collapsing, and it did collapse several times, they would buy dollars. And when they bought dollars, in dollars it made gold look less valuable. But if you go down to the year 2001, you see the gold valuation has just taken off. Well, how much gold do pension plans in America have? And go to the next slide. This is something that was put together by a guy named Sean McGuire. He presented it at the London Bullion Market Association in Berlin. And roughly the gold holdings of U.S. pension plans are on the order of 0.15%. I mean, today that sums to something like $17 billion out of roughly $12 trillion in pension funds. These pension funds are naked. So the Teachers Retirement Fund, the New York State Retirement Fund, the New York City Retirement Fund, they are naked. And so when the irredeemable paper ticket money goes away, and you can see with your own eyes it's going away, all of the people who are supposed to get pensions, they're going to get fully paid with the irredeemable paper ticket money, but that irredeemable paper ticket money is not going to buy anything. And if you look at what's happening on a worldwide basis, this data was put together by the McKinsey Company, and it shows all the financial assets going back to around 1980. Today, it's roughly something shy of $200 trillion. I don't know if you can see on your screens, but that little red sliver at the very top, that's gold. So roughly out of $190 some odd trillion in 2009, maybe there's $2 trillion in gold. The rest is either in the irredeemable paper ticket money or securities denominated in the paper ticket money. And historically, Again, everybody knew about this in the 19th century. The way to protect savings, jobs, and have a prosperous economy was with gold. And I want to end with that tagline. Gold is the protector of jobs, and savings, and prosperity. And go to the very last slide. Folks, this ends the Larry Parks Show for tonight. I'm Larry Parks. I want to thank you so very much for taking the time to watch. If you think you've learned something from this, and if you think this information is valuable, please join our noble fight for honest money by making a fully tax-deductible contribution to FAME and send it to fame.org, Box 625, FDR Station, New York, New York, 10022, 0625. And again, thank you, sir, very much for taking the time to watch the Larry Parks Show. I'm Larry Parks, and good night.